Most people hear the word debt and immediately think danger. And to be fair, they are not wrong. Bad debt can wreck your peace, drain your income, and keep you trapped for years. But there is another side to this conversation that almost nobody talks about honestly. Because debt is not always the enemy. Sometimes debt is a tool. And in the right hands, with the right numbers, and with the right discipline, it can become one of the fastest ways to build wealth. That is the part most people never learn. They are taught to fear borrowing. They are taught to avoid leverage at all costs. They are taught to save slowly and hope inflation does not eat their future. But the wealthy often play by a very different rulebook. They do not just ask, "Can I afford this?" They ask, "What is the math?" And that question changes everything. In this video, I want to break down the real truth about using debt to build net worth in 2026. Not hype. Not fantasy, not reckless borrowing, just the real strategic difference between debt that destroys and debt that can accelerate. So let's slow this down and look at the actual numbers. Debt is not one thing. The first thing you need to understand is that debt is not all the same. There is bad debt, there is dangerous debt, and then there is strategic debt. Bad debt is the kind that buys things that lose value fast, things that do not produce income. Things that make you feel richer for a moment, but poorer over time. That kind of debt is heavy. It can crush your monthly cash flow and make every paycheck disappear before you feel it. But strategic debt is different. Strategic debt is borrowing that gives you access to something with upside, something that can grow, something that can produce cash flow, something that can improve your balance sheet instead of weakening it. That does not mean debt is safe. It does not mean debt is easy. And it definitely does not mean everyone should use it. It means the math matters. Because the real question is not, is debt good or bad? The real question is, what is the return compared to the cost? The spread is everything. Here is where the math becomes important. If you borrow money at one rate and use it in a way that earns more than that rate, the spread can work in your favor. That spread is the gap between what you pay and what your capital earns. For example, if you borrow at a low cost and use that money for an asset that has the potential to grow or generate income at a higher rate, you're trying to make the borrowed money work harder than the debt costs you. That is leverage. And leverage is powerful because it allows your own capital to go further. Instead of waiting years to save enough cash for one opportunity, you may be able to access capital now and use it to buy, build, or position yourself faster. But this only works if the numbers are real. If the cost of borrowing is too high or the asset does not perform, the whole thing falls apart. That is why smart debt is never about emotion. It is about a margin of safety. Why wealthy people use leverage. Most people think wealthy people are rich because they simply earn more. Sometimes that is true, but often the bigger difference is not income. It is how they deploy capital. Wealthy people tend to understand something very important. Money sitting idle loses momentum. Cash that is doing nothing is not just sitting there. It is slowly being eroded by inflation, missed opportunities, and time. Meanwhile, capital that is deployed into the right assets can keep moving. That is why leverage is so attractive to sophisticated investors. It allows them to keep money working in more than one place over time. One asset can be producing income while another is appreciating. One line of capital can help acquire another income-producing asset, and that cycle can continue if the structure is sound. This is the idea behind capital velocity. Not hoarding, not gambling, not chasing trends, just keeping money active in a disciplined way. The real risk. Now, let's be honest. This is also where people get destroyed, because leverage feels smart when everything is rising. It feels powerful when cash flow is strong. It feels easy when the market is calm, but debt becomes dangerous the moment the environment changes. Interest rates can move. Asset prices can drop. Income can slow. Vacancies can rise. Business conditions can shift. And when that happens, leverage that looked brilliant on paper can become a burden. That is why the line between strategic debt and financial ruin is so thin. One side is controlled. The other side is careless. One side is protected by strong reserves and low risk. The other side is exposed. The mistake is not using debt. The mistake is using debt without a plan. The safety rules. If you're going to think about debt strategically, then you need rules, not vague ideas. Real rules. First, never borrow without knowing exactly how the debt will be repaid. Second, never rely on optimistic assumptions alone. You need conservative numbers. Third, stress test the debt before you take it on. Ask yourself what happens if the asset earns less than expected. What happens if rates rise? What happens if the market drops? What happens if your income slows down? If the answer is panic, then the structure is too weak. Fourth, keep a margin of safety. This means you should never be so leveraged that one shock destroys the whole plan. A smart investor leaves room for error because the goal is not to look impressive for 1 year. The goal is to stay in the game for 10. Liquidity is power. One of the biggest mistakes people make with money is locking everything up. They buy assets, but leave themselves with no flexibility. They look rich on paper, but poor in reality. That is why liquidity matters. Liquidity is your ability to move, adjust, and survive. If you have no liquidity, even a good asset can become a problem during a bad season. This is one reason some investors prefer structures that provide access to capital without forcing them to sell their core holdings. It is not about being fancy. It is about preserving optionality. Because optionality gives you choices, and choices are valuable. When you have liquidity, you can wait for the right deal. You can handle surprises. You can avoid panic selling. You can make decisions from strength instead of desperation. That is a major difference. Debt and inflation. Now let's talk about something people feel every day, even if they do not talk about it much. Inflation. When prices rise and money loses purchasing power, the value of cash sitting idle can shrink over time. That is why some people see low-cost debt as a possible tailwind during inflationary periods. If you borrowed money at a fixed cost and the value of money falls over time, the real burden of that debt may become easier to manage, assuming your income or assets are also keeping up. Again, this is not a free pass. It is just part of the math. The key is that debt and inflation interact. That interaction can help you or hurt you, depending on how you structure your balance sheet. If your debt is fixed, manageable, and tied to productive assets, inflation can sometimes work in your favor. If your debt is expensive and your assets are weak, inflation makes your situation worse. So once again, the rule is not use debt. The rule is understand the environment before you borrow. Capital should move. A lot of people think wealth is built by saving as much as possible and refusing to take risk. But saving alone usually does not create rapid wealth. Saving is important. It protects you. It gives you stability. But wealth often grows faster when capital is moving. That is the big difference between preserving money and compounding it. The wealthy often think in terms of systems. They ask how one asset can help fund the next, how one cash flow can support another, how one structure can create more capacity. That is why people talk about debt ladders, refinancing strategies, and portfolio leverage. Not because debt is magic, but because capital can sometimes be recycled instead of frozen. When done correctly, the same dollar can be part of multiple opportunities over time. That is the velocity of capital. And velocity matters. Personal to institutional. At some point, the conversation moves from personal finance to structure. At the personal level, debt may look like a mortgage, a business loan, or a carefully managed credit line. At the institutional level, the conversation becomes more advanced. Now you're thinking about corporate borrowing, asset-backed structures, tax efficiency, and long-term balance sheet design. This is where many people begin to realize that wealth is not just about how much you earn. It is about how your assets are arranged, how your liabilities are managed, how your cash flows are protected, and how your capital can keep compounding without breaking your stability. That is why the mindset shift matters. You stop seeing debt as a moral failure, and you start seeing it as a financial instrument, but only if it is respected, because the same instrument that can help you grow can also bury you. The mindset shift. This is the part that changes everything. Poor people often ask, how do I avoid debt? Wealthy people ask, what is this debt doing for me? That does not mean one mindset is always better than the other. It means the question changes based on your strategy. If debt is buying consumption, it is likely a loss. If debt is buying productivity, income, or growth, it may be a tool. That is the difference. And when you understand that difference, you stop making emotional money decisions. You stop reacting to fear. You stop chasing shortcuts. You stop confusing leverage with intelligence. Real intelligence is knowing when not to borrow. Real discipline is knowing how much risk you can actually carry. Real wealth is staying alive long enough for compounding to work. The final truth. So here is the truth about using debt to build net worth in 2026. Debt is not a shortcut. It is a multiplier. And multipliers can help you or hurt you depending on what they're multiplying. If you multiply weak habits, you get bigger problems. If you multiply strong assets, you can accelerate your future. That is why the math matters so much. Before you borrow, ask, what is the cost? What is the upside? What is the downside? How bad can this get? And can I survive the worst case? If you cannot answer those questions calmly, do not borrow yet. But if the math works, the risk is controlled, and the asset has real potential, then debt may not be your enemy. It may be one of the tools that helps you build something bigger. And that is the real truth most people never learn. Not all debt is the same. Not all leverage is reckless. And not all wealth is built by saving alone. Sometimes, wealth is built by understanding the math well enough to use capital wisely. And once you understand that, you will never look at debt the same way again.